Well, I've been thinking about something lately, something that most people don't talk about at dinner tables. See, I'm in my 70 seconds now, and I've watched a lot of fortunes get made and lost. But there's this thing, this strategy that the truly wealthy use, and it's so simple, so elegant that when you first hear it, you might think, wait, that's it. It's called buy, borrow, die. Now, I know that sounds a bit morbid. The die part tends to get people's attention. But stick with me here, because what I'm about to share with you, well, it's probably the most powerful wealth building secret that exists in America today. And the funny thing is, it's completely legal. You see, most people work their whole lives. They earn a salary, they pay taxes on that salary, and then they try to save what's left. That's the traditional path, and there's nothing wrong with it, really. It's honest work. But the ultra wealthy, they don't play that game. They've figured out something else entirely. Let me walk you through this slowly, because once you understand it, you'll see the world differently. You'll see why the rich keep getting richer, and why the system, whether you think it's fair or not, is designed the way it is. So let's start with the first word, buy. Now, when I say buy, I don't mean buying stuff. I don't mean cars or boats or fancy watches. I mean buying assets, real assets, things that grow in value over time, great businesses, real estate, stocks in companies that are going to be around for decades. See, when you buy a good asset, it does something magical. It appreciates, it grows. And here's the key. As long as you don't sell it, you don't pay taxes on that growth. Let me say that again, because it's important. As long as you don't sell, you don't pay taxes. That's called unrealized gains. The IRS doesn't tax you on paper profits. Only when you actually sell and realize those gains, that's when they come knocking. Now, most people don't think about this. They buy a stock, it goes up, they get excited, they sell, they pay capital gains tax, and that's fine for small amounts. But when you're talking about serious wealth, selling is the last thing you want to do. I'll give you an example. Let's say you buy 100 shares of a great company, Microsoft, for instance. I've owned Microsoft for decades. And over time, those shares go up, way up. If I sold them, I'd owe capital gains tax. Long-term capital gains are about 20% federally plus state taxes in some places. So you're looking at maybe 23% to 25% going to the government. But if I never sell, I never pay that tax, the wealth just keeps compounding year after year, decade after decade. That's the snowball effect. You let it roll, and it gets bigger and bigger without the IRS taking a chunk out of it every time you make a move. And I've seen this play out not just with tech stocks like Microsoft, but with all sorts of assets. Take farmland. I've invested billions in farmland across the US. Why? Because land appreciates steadily over time, driven by population growth and food demand. It's not flashy like AI or software, but it's reliable. You buy it, it grows in value, and as long as you hold it, no taxes on that appreciation. And meanwhile, it can generate rental income from farmers, which you can reinvest or use wisely. It's part of building that foundation of assets that work for you. Now, here's where it gets interesting, because you might be thinking, okay, Bill, that's great, but what if I need money? What if I want to buy a house, start a business, or just live my life? Good question. And that brings us to the second word, borrow. This is the part most people don't understand. The wealthy don't sell their assets to get cash. They borrow against them. Let me explain. Banks love lending money to wealthy people because wealthy people have collateral. Stocks, real estate, businesses, all kinds of assets. And the bank can say, okay, we'll lend you money, and if you don't pay us back, we'll take the assets. It's a safe bet for them. And for the borrower, it can be brilliant. Here's why. When you borrow money, a loan is not considered income. The IRS doesn't tax borrowed money. So you can borrow millions of dollars and pay zero taxes on it. Now, you do have to pay interest, but for people with great credit and strong collateral, that interest rate can be relatively low. And while you pay that interest, your assets are still growing. If your investments are growing at 8% or 10% a year and you're borrowing at 3%, you're making money on the spread. You're using the bank's money to live while your own money keeps compounding untaxed in the background. Let me make it concrete. Say you've got $10 million in stock. You don't want to sell it because you might owe maybe $2 million in taxes, and you believe in what you own. So instead of selling, you go to a bank or a wealth management firm and say, I'd like a loan. I'll put up my $10 million in stock as collateral. The bank looks at it and says, sure, we'll lend you $3 million. That's a conservative loan to value ratio, 30%, say for them. Now you've got $3 million in cash, tax-free. You can buy a house, start a business, travel, whatever you want, and you haven't sold a single share. Meanwhile, your $10 million in stock is still growing. Let's say it grows 8% a year. That's $800,000 of growth annually, unrealized, untaxed. And what are you paying on the $3 million loan at 3%? About $90,000 a year. So your assets are growing by $800,000 and you're paying $90,000 in interest. You're up $710,000 without paying a dime in capital gains tax. That's the mechanics. Elegant if you understand it. And it's not just me. Look at people like Elon Musk or Jeff Bezos. Reports have shown how they borrowed against shares instead of selling. Borrowing gives them cash without triggering capital gains taxes the way selling would. It's smart, and it also shows how the system favors people who already own large appreciating assets. Now, I know what some people are thinking, Bill, isn't that risky? What if the market crashes and your stocks go down? Sure, there's always risk, but here's the thing. Wealthy people typically don't borrow to the max. They borrow conservatively 30% loan to value, maybe 40%. So even if the market drops 20% or 30%, they've still got cushion, and we're talking about long-term investing here. The market goes up and down, it always has, but over decades, it tends to go up. If you're patient and you're not forced to sell at the bottom, you can survive a lot of volatility. All right, so we've covered buy and borrow. Now let's talk about the last word, the one that makes people uncomfortable, die. I don't mean to be grim, but death is part of life. And in the world of taxes, it's a major moment. Here's why. When you die and leave assets to your heirs, something incredible can happen. It's called the stepped-up basis. Let me explain. Say you bought stock for $100,000 decades ago, and now it's worth $10 million. If you sold it while you were alive, you'd owe capital gains tax on that, $9.9 million gain. But if you never sell and you pass away and you leave that stock to your kids, the IRS says, okay, the new basis is $10 million. That $9 million gain effectively disappears for capital gains purposes. Your heirs can sell it the next day for $10 million and owe zero capital gains tax. It's like a reset button. The appreciation during your lifetime from a capital gains perspective is wiped clean. Now, there can be estate taxes if your estate is large enough, and there are ways people plan around that. Trust, charitable giving, gifting strategies. Wealthy people have teams of lawyers and accountants working through this. But the core point is this: the capital gains tax often never gets paid. You bought assets, you borrowed against them to live, and then when you died, the capital gains liability vanished. Buy, borrow, die. And yes, this stepped up basis is a big reason generational wealth can survive. Families with large asset bases can pass wealth down without the capital gains erosion you would see if they sold assets repeatedly during life. Now, I want to step back because some of you are thinking, Bill, is this fair? Should this be legal? That's a fair question. I've said publicly many times that I think wealthy people should pay more in taxes. I think the system is tilted in ways that aren't quite right. I pay a lower effective tax rate than some people who work hard for wages. That's not because I'm doing anything illegal. It's because the tax code is written to favor investment income over wage income in many cases. But here's the reality. I didn't write the tax code. I don't control Congress. I'm playing by the rules that exist. And whether you like it or not, the system exists. Understanding it is the first step to operating inside it. Let me tell you a story. Years ago, I knew a man, I won't say his name, but he'd built a very successful business, smart, hardworking, made millions. Every year he'd sell stock to fund his lifestyle. Nice house, nice cars, vacations, and every year he'd pay capital gains taxes. One day we're having lunch and he's complaining about his tax bill, and I said, "Why are you selling? Why not borrow against your stock instead?" He looked at me like I was crazy. Borrow? I don't want to be in debt. And I said, this isn't consumer debt. You're paying 3% to borrow. Your stocks are growing at 10%. You're making money on the spread. And you're not triggering capital gains tax. He thought about it. Eventually, he started borrowing instead of selling. And his wealth grew faster because he stopped interrupting compounding with taxes every time he needed cash. Now, I want to be clear. This strategy is not for everyone, especially not at the beginning. If you don't have significant assets yet, it doesn't apply to you, not yet. But it's something to build toward. You don't need $10 million to start, but you do need assets and discipline. You need to save. You need to invest. You need to resist the urge to spend everything you make. I've lived in the same house in Medina for decades. People ask, why not buy something bigger? And I always say the same thing. I'm happy where I am. I don't need more. Every dollar you don't spend on unnecessary things is a dollar that can keep compounding. That's the mentality. Live below your means, invest the difference, let it grow. And let me talk about real estate because buy, borrow, die works beautifully there too. Say you buy a rental property for $500,000. You put down $100,000 and take a mortgage for the rest. Over time, you pay down the mortgage and the property appreciates. Eventually, it's worth $1 million. Now, you could sell it, but if you do, you owe capital gains tax on the gain and you may face depreciation recapture, or you do a cash out refinance. You borrow against the increased value, pull out cash, and because it's borrowed money, it's generally not taxed like income. You keep the property, it keeps appreciating, you keep collecting rent, and when you die, your heirs get a stepped up basis. Buy, borrow, die. Same pattern. Now, some people hear all this and say, so this is just a way for rich people to avoid taxes. And yeah, in practice, that's part of what it does. But the tax code was designed to encourage certain behaviors. Governments want investment in businesses, housing, productive assets. So they create incentives. Capital gains are taxed differently than wages. You can argue about whether it's fair. And I do think reform is worth talking about. But the system today rewards long-term ownership of assets. Let me paint a simple picture. Imagine two people, both earn $100,000 a year. Person A spends $90,000 and saves $10,000, puts it in a low-interest account, and after 40 years, they've got maybe $500,000. Person B saves $10,000 too, but invests it in assets that compound at 8% or 10%. After 40 years, they've got over $2 million. And then person B doesn't sell. When they need cash, they borrow conservatively against the asset base. Their wealth keeps growing. When they die, their heirs inherit with a stepped up basis. No capital gains tax ever paid on decades of appreciation. That is how the difference gets created. Now, risk, because I don't want to sell you fantasy, borrowing can be dangerous if you do it wrong. If you borrow too much and the market drops, you can get forced to sell at the worst time. So the rule is simple: be conservative. Keep borrowing at 30% to 40% of asset value, not 80% or 90%. Borrow only against assets you believe in for the long haul. Stable businesses, real estate in good locations, things that will still be here in 20 or 30 years. Risk comes from not knowing what you're doing and from over leverage. I have a friend, again, I won't name names, worth a few $100 million, mostly stock from a company he founded. He lives extremely well, but he's never sold a single share. How does he pay for life? He borrows. He has a line of credit secured by the stock, and he draws from it. The stock keeps growing. The interest is less than the growth rate, so he gets richer while covering expenses. And when he dies, the heirs get that stepped up basis. That is buy, borrow, die in real life. And beneath all of this is compounding. Compounding is the most powerful force in finance. Buy, borrow, die works because it protects compounding. Every time you sell and pay taxes, you interrupt compounding. You take money out of the machine, but if you hold great assets and avoid triggering taxes repeatedly, the compounding continues year after year, decade after decade, and the snowball becomes enormous. There's also a philanthropic angle. If you have appreciated assets, you can donate them directly to charity. In many cases, you get a deduction for the market value and you avoid paying capital gains tax on the appreciation. I pledge to give away the majority of my wealth, and a big part of that is donating appreciated assets in the most efficient way possible. So more goes to the cause and less gets lost to unnecessary friction. So why doesn't everyone do this? First, you need assets. Banks don't give great borrowing terms to people with no collateral. Second, most people don't think this way. They think paycheck, bills, savings, retirement. Third, there's a psychological barrier. People hear borrow and they think credit card debt or car loans, the kind of debt that destroys people. But this is different. This is strategic borrowing against appreciating assets used conservatively with a long-term mindset. And that's really the core of it. Buy good assets. Hold them, borrow against them conservatively. If you need liquidity, let the assets compound and understand what happens at death with stepped-up basis. It's not magic. It's the structure of the system. Now, I'm not saying everyone should build a dynasty. That's not the point of life. But if you want financial security, if you want to leave something for your kids or for charity, this is a blueprint. Simple does not mean easy. It takes discipline, patience, and long-term thinking. So I'll wrap it up like this. First, know that the system rewards investors and long-term asset ownership. Second, protect compounding. Third, don't confuse consumer debt with strategic borrowing. Fourth, think in decades. I'm in my 70 seconds now. I've seen booms and busts, fortunes made and lost. But the constant is this: people who buy strong assets and hold them, people who let time and compounding do the work, they win. Buy, borrow, die isn't just a catchy phrase. It's a description of how wealth moves through the system. And now you know it too. If this resonates, start where you are. Focus on buying assets, even small ones, and building the habit, and let compounding start working. Avoid the kind of debt that destroys your flexibility. And over time, as your asset base grows, you'll have more options. That's the real goal. Options, freedom, the ability to build something that lasts. All right, that's it. Thank you for listening, and good luck out there. And if you're going to do anything after this, don't just nod. Start today. Buy something productive. Save something, invest something, and play the long game.